Yesterday we started with console and we did some theoretical framework on the consolidated financial statement by looking at some definitions of parent, subsidiary, control, and then significance influence. We said that control is determined by the voting right and that you should have more than 50% before you can call yourself a parent. But then, however, there are some three instances whereby you don't necessarily need to have the 50% or more. And so we looked at instances whereby the other companies have agreed to allow you man up the company on their behalf, or the court has also instructed you to control the firm, or you have the power to appoint majority of the board of directors for the company, though your voting right is less than 50%. Then we also looked at what non-controlling interest really meant. We looked at what a significant influence is because it is an associate who falls between 20% and 20 and 50%. That is considered as an associate. And then we discussed a few things where someone will not be called a parent. We said that you cannot be called a parent to consolidate account if you are not trading on the public markets where the entity has not filed nor has the intention to file for uh, issue instrument, and then also when the parent prepares the financial statement and you don't prepare the financial statement, you have exclusion from being called a subsidiary or a subsidiary not unable to prepare the consolidated accounts. We went through that and then we realized that we have some few regulatory that would regularize the preparations of consolidated financial statement. And one was the Ghana Companies Act 2019, Act 992. Then we have the International Financial Reporting Standards 3 business combination, where you combine two or more businesses. Then we have the IFRS 10 that is looking at the consolidated financial statement, preparing financial statements of two entities whereby parent and then subsidiary relationship exist. IAS 27 that talks about separate financial statement. I stated it clearly. Um, a minute, a minute, a minute, a minute. Naomi,
Yes.
all right, so please let's continue. Then we look at IS 28. That is why I'm saying that it is an associate. I would have a time to discuss what we call the associate. But an associate basically is looking at someone you don't control, but then you have significant influence. And I told you the key things to be looking out for from an associate. That is their profits they made, and then maybe an adjustment of their investment in you. These are the two things that you'll be looking at when you're picking from an associate. So once we go ahead and solve more questions, you become abreast with that concept. Now we look at the International Financial Reporting Standard 11, which talks about joint arrangement. If I have a joint arrangement with you, the concern is to do business, realize profit, split the profit, and then we go away. Then the IS1 is looking at the presentation of the financial statement, how to present the financial statement. And usually, because you're accountant students, we know them already. Now, this financial statement you'll be doing at this level will be the statement of financial position, statement of financial performance, and cash flow statement. But then, even with CA, the questions that we see regularly is either statement of financial performance or statement of financial position. So, from time to time, if we have a question on statement of cash flows, we'll let you know and then we'll solve them together again. Okay, so this is just the regulatory framework, those that regularize the consolidated financial statements. Then we looked at how to prepare the consolidated financial statement. It is not a must to follow this seven approach, but then it will be very beautiful if you can go according to the seven approach. It is not a must to go according to the seven approaches that I have here. Your lecturer would have another approach, but then it will make your work organized if you can follow the seven approach that I have. Now, the first approach is to determine the level of control and then look at the effective date of control in the question. The second one is to look out for your cost of investment in the question. And yesterday we went to the cost of investment, such as your consideration. We went through a lot and then we realized that we have four types or five types of consideration: your cash, your loan, the share exchange, the deferred considerations. We have the contingent consideration. I explained all these in the video yesterday. Point three is to look out for our split. We call it split or net assets of the parent or the subsidiary. So you'll be doing the net asset of the subsidiary, normally called split. SPILT, split. So you realize that your lead facilitator will be writing split. Hey, did I say SPIL, split it? I don't even know how to spell. That is how I spell it on the board. Now I gave you a few items that would be there, but then I stated that it's looking at the net asset at acquisition and then at reporting to know if there were existing profit or if there had been some profit made or some benefit made, which is called a post-acquisition profit after you bought the company, the profits that they have made, so that you also capitalize on it as well. So this is what we call the post-acquisition profit. So at acquisition, the things they had at the year end, the things they had, and had they made some acquisition profit on them, we need to capitalize on that too as well. Having said that, we stated some items right under it, and then I referred you to some question. So we can have share capital, retained earnings. You can have fair value adjustment. Where we say fair value adjustment, at the time you bought the company, they had some assets. So you bought these assets from the company, and then you decided that you go and look at the market price of the asset. Now, when you were buying the asset, you bought it for 4,000. So you have charged depreciation on just the 4,000. Therefore, when you go and the market value is 6,000, it means that you have undercharged depreciation. So we need to now charge depreciation again and go and deduct it in your split account. So that is one thing that you should know. Depreciation that was undercharged must be deducted, but depreciation that was overcharged must be added. This statement is very confusing, so I'll not be repeating it more often. If you want to write it, that you write it down. Depreciation undercharged will be less. Depreciation overcharged will be added to the split account. That is when you look at your fair value. So we get a question, you see how fair value is and what I meant by undercharge, overcharge, then you know what to do. Now, so anytime there is a fair value, look out for depreciation, except the question specifically tells you that no depreciation must be charged again. And you know depreciation would affect your statement of financial position and would affect your statement of financial performance. So though you'll be thinking about the workings, you must look out for whether it is going to affect the trading profit and loss account or it's going to affect the balance sheet. Okay. Then at the fair value adjustment, we have something we call unrealized profit. What is the meaning of unrealized profit? When you bought the company, you guys traded. You traded with your subsidiary. Now, trading with the subsidiary, you realize that you sold goods to the subsidiary. Okay. Selling goods to the subsidiary, you sold it at a cost plus profit. And the subsidiary also bought them. At the end of the period, the subsidiary did not utilize all the goods. He did not sell all the goods. So the goods he has or the subsidiary has in inventory, at the closing inventory, we need to compute what we call an unrealized profit on it. Now, If the parents rather bought the goods, it will not show up in the split account. The split account is to cater for just the subsidiary. So if it has to do with the subsidiary, that is when we are going to prepare what we call the unrealized profit and bring it in there. But if the unrealized profit is made by the parent, when we say the unrealized profit, I take it again. A and B. A is a parent. B is a subsidiary. B bought goods from A, couldn't sell all the goods, but then made some profits on it. So those goods that are left, the profits that are on that goods, we call them unrealized profits. So we need to come and then less it again from the split account. Okay. So that is a few elements. So normally with a split account, you can't get the element all except you solve more questions. Then you begin to ask yourself, oh, okay, so I can see this element here, I can see this element here, I can see this element here. It varies according to question. So there is no specific with respect to the split account. All right. Then point four, I told you, you need to look at goodwill computation. It says goodwill computation is considered plus non-controlling interest fair value, if any, less the net asset at acquisition proportionate share of the net asset, applying the percentage on the figure, less impairment. Okay, what does it really mean? You see, if the fair value is not, if the NCI is not fair value, when you pick the consideration you had given, you need to find the proportionate, that is the percentage of the NCI on the net asset at acquisition. Net asset at acquisition. Before you add them up. But then if fair value of NCI is given you, you don't need to find the percentage of the net asset for the NCI. So this acquisition, net asset at acquisition, if it is 200 and the non-controlling interest is 20%, they are just telling you, find 20% of the 200, come and add it to the consideration you have realized. The total that you are going to make, go and pick the whole 2,000 and then come and less it. That is the net asset at acquisition. Come and less it. Now, if you don't find the NCI of it, it means that you can't use the entire 2,000, but then according to standard practice, currently, that is what we do. You just have to find the NCI's percentage on the net asset at acquisition before we can do the goodwill. All these things are just theory. The next one is to cancel intragroup transaction. I've told you what intragroup transactions are. The investment you took in the subsidiary, you don't need to record it as part of your assets. That is one. Then two, when you sell goods to the subsidiary, you need to cancel it. You need to eliminate it from the books. So if it was added to sales, eliminating it from sales means that you must subtract it. Sales has a credit balance. So to eliminate it from sales, your lecturer will be doing debit sales and then credit cost of sales to eliminate it. And then the vice versa. So you debit sales to eliminate it. Then you credit cost of sales also to eliminate it. Now, if you sold the goods on a credit basis, like I told you, if you sold the goods on a credit basis, it means that you have already debited your debtor and then credit your creditor. So you credit the debtor's account to cancel it. You credit the debtor's account to cancel it. Then you debit the creditor's account also to cancel it. So that is the cancellation that we'll be doing here. When it happens to sale of goods, this is how you go about it. But when it happens to the amount of money the parent invested in the subsidiary, because investment account is an asset account, you go and credit it to nullify it, and then you credit a different account called cost of control. That's when you credit it to also, you debit it to also cancel it out from that account. All right, so then you come to the non-controlling interest. You first pick the fair value of the non-controlling interest. you pick their portion of the post-acquisition profit and add it. Then you check if there is any NCI impairment in that question. So either you pick their fair value if it's given. If fair value is not given, you pick their percentage of the net asset at acquisition, percentage of NCI's net asset at acquisition. At acquisition, that is what you pick, plus any percentage, plus their percentage on the post-acquisition profit. So if your post-acquisition profit is going to be wrong, it means that you are going to get everything zero, zero, zero. All right. Um, Having said that, I said we do what we call consolidated retained earnings, whereby you pick the retained earnings in the balance sheet, your post-acquisition profit will come in there, your unrealized profit will come in there, your impairment will come in there, your depreciation would also show up there. Any losses that were made during the period will show up in the consolidated retained earnings. This is how the structure needs to be looked at. But then first and foremost, whenever a question is given you, I said that you need to write out the question details down, except it is an objective, and then you are not going to solve it. You are not going to prepare, but then rather the focus will be for you to find and determine the items one after the other. When I say objective questions, what do I mean? Okay, so particularly this question, all right, particularly this question, it gives you the financial statement, and then it gives you the first questions. It says question one, determine property, plant, and equipment. So if you know how to determine property, plant, and equipment, you are good to go. Just like I said, if it is a balance sheet item, you just have to add the parent to that of the subsidiary and await any pending computation that will be done, like depreciation, like fair value of the asset, and then any other item that would come in there. So this one will be possible if you read the additional information. It will be possible if you read the additional information. All right, having gone through, we have a beautiful question. First and foremost, if you have the question, you go and read the requirement of the question. In this question, the requirement is prepare the consolidated statement of financial position of the Adidome Group Limited Group at as at 31st December 2012. So quickly in your workbook, you go and write Adidome Group. Adidome Group. Then you underline it because that is what you've been asked to do. Then you come and write consolidated financial position of the Adidome Limited as at 31st December 2012. I can write it here. So you write it plain, console, then you write it, or then you now read the line again as well. Now, having done that, you know the Ghana cedi signs will come because you are doing a balance sheet. And the next one. So I said that you pick the financial statement, repeat all the items here, but make allowances. Even if you're not able to do anything, just repeating them, you can get like 6 marks for free. So one of the things your lecturer will tell you, you are not expected to get all correct, but then just go and list the items there, KK, for some marks. So I start PPE, property, plant, and equipment. And I told you, since it is balance sheet, it is quite easy and straightforward. So I just open parentheses like this, 80,000, 58,200. So I just do 80,000 plus 52,800. Now I'll not close the bracket because there'll be adjustments on the account. So I'll just leave it like this and then go and pick the next item, which is investments. So investment two has just one item. So I pick investments. Then I write 84,000. Then I'll leave it. Then I'll leave some space because after the investment, the next I see is total. But then anticipate that there'll be some two or more items that will come here. An example is the goodwill. An example is the goodwill. It's a non-current asset, an intangible non-current asset that you cannot see, touch, but then it is N. So you can just leave like three spaces, one for goodwill, one for another item, and then the other for the total. So you leave the three spaces, then you go to the next line and go and write current asset. Then you pick inventory, then you open brackets, inventory, then you have 18,000 plus 12,000. Then you leave the rest. Now, the rest will come as a result of reading the adjustment, that is the additional information, before you can now know that, oh, okay, this is this and this and this is what I'll be doing on each of the accounts. Now, after you have copied everything on the first page, you can now flip behind your answer booklet and do your workings. So you concentrate on the workings. When you are done, that is when you feed the main page with the responses that you are going to get from your workings. Is that clear? This is a trick for you to get some free marks before you even come and start the main work. So I always tell students, don't pray to get an objective. If you get an objective, you'll not get some free marks. You'll be wondering. But if you get subjectives in questions like this, you're good to get some free marks. Please, is that clear? Is that clear?
Yes,
Yes, sir.
please.
Yes,
Okay.
please.
All right. I just wanted to hear your voice. If not, I'll go and leave you people. So now that we have been able to establish how to go about it and know what the requirement of the question is about, let us quickly read the questions and see if we can do all the adjustments before we leave here this morning. All the adjustments before we leave here this morning. Okay. Summarized statement of financial position of Adidome Limited and Akachi Limited as at 31st December 2012 were as follows. Non-current asset, PPE, investment, current asset, inventory, trade and other receivables, cash and bank balances, then current account Adidome Limited. Then we come down to total assets, equity and liabs, current liabilities, trade and other payables, current account, Akachi Limited. Then we come to total liabilities, then we come to equity funds, stated capital, income surplus, capital surplus, total equity funds, total liabilities and equity. The following information is relevant. Information number one, on 1st January 2010, Adidome Limited acquired 48,000 of the equity shares in Akachi Limited for 84,000 Ghana cedis, when the balance on the income surplus of Akachi Limited was 8,000, whilst the balance on the capital surplus account was 13,000. On the date of acquisition, one item of plant of Akachi with a book value of 4,000 had a fair value of 6,000 Ghana cedis. The plant had a remaining economic life of 4 years. The valuation had not been reflected in the separate statement of financial position of Akachi Limited. Point 3. During the year, Akachi Limited sold goods to Adidome Limited at a markup of 25%. As at the end of the year, the inventories of Adidome Limited included 4,000 of the goods from Akachi Limited. Point number 4. A check for 500 Ghana cedis from Adidome Limited to Akachi Limited sent before 31st December 2012 was not received by the latter company until January 2013. Point 5. An impairment review at 31st December revealed that the goodwill in respect of Akachi Limited had fallen in value over the years by 500 Ghana cedis. By 1st January, these goods would have already suffered an impairment totaling 1,700 Ghana cedis. Point six, the stated capitals of Adidome Limited and Akachi Limited are made up of 120,000 Ghana cedi and 60,000 issued ordinary shares respectively. The shares were issued at 1 cedi each. Point seven, the group policy is to fair value the non-controlling interest. The market price per share of Akachi Limited on 1st January 2010 was 1.4. Required, prepare the consolidated statement of financial position for Adidome Limited Group as at December 1st, 2012. So, after reading through this question, we have been given some 7 guided steps. So let's quickly think about going according to the steps, or think about finding out what every information on the line is saying. So the first information on point 1, we can realize that so many things have been given in point 1. So for point 1, we can determine the group structure. And I said that with this group structure determination, you need to understand how to find it. The number of shares Adidome has acquired was 48,000. Ask yourself, how many shares are there in Akachi? So if you've not read through the question thoroughly, you can't find the number of shares in Akachi. Akachi had only 60,000 shares. And then you bought 48,000 of the shares. Now, the 48,000 of the shares out of the 60,000, out of the total number of shares, multiplied by 100%, will tell you the number of share percentage you have. It will tell you the parent and then the subsidiary percent. So 48,000 divided by 60,000 multiplied by 100. What did we establish?
80%.
80%. Therefore, the non-controlling interest in this question will be what?
20%.
20%. All right. So we can quickly have you can draw a table. So let's say Adidome AD. Then you draw this line. Then you have AK Akachi. Then you write 80%. So once you do this, you've been able to establish what we call the relationship or the percentage that is owned by the parent in the subsidiary. The percentage owned by the parent in the subsidiary. Now, what will be the effective date of control? Effective date of control. Effective date. The effective date is when you bought the company. At what time did you buy the company? 1st January 2010. Some people add what we call the period of control. Period of control. Do you know why we add a period of control? No, I'll tell you later. Now, we bought the company on 1st January 2010. We are now preparing an account for December 12. So how many years are there? So we have from 1st January, like you did in taxation, 2010. The end year is always in 31st December 2010. So that gives you 1 year. The next would have started from 1st January 2011 to 31st December 2011. That would be another year. And the last one would have been 1st January 2012 to 31st December 2012. So the period, we can see how many years involved. 3 years. Is that clear? Is that clear?
Yes.
All right. So we've been able to establish two things from point number one. We've been able to determine the group structure. We've been able to determine the effective date of control. Been able to determine the period of control. That is the first step we were supposed to do. Okay. Now, the next step for me to tell you here is that they said that you actually paid cash here. You can see that the consideration was so clear. The consideration they paid for, they stated it was in cash and it was 84,000. And you can see some investment in the question. Adidome did some investment of 84,000. So once you open the parenthesis and write 84,000, go and less the 84,000. Sometimes the investment Adidome had taken, it is not the investment for just the subsidiary. They have other investments. So don't assume that the investment figure you see under the parent company, everything is attributable to the subsidiary. It is unfortunate, or it is fortunate, that this question, investment in the associate, was exactly the investment in the question. So this is the intragroup transaction that we are talking about. So you go and cancel that investment. So I stated the investment and then goods that you put. So though you might open the parentheses and then go and subtract the 84,000 and have zero, it is okay to write them in the format. I'm taking it again. It is an intergroup transaction. Your consideration you paid is what you have actually invested in the subsidiary. So go and deduct that contribution. That is why we determine the cost of investment. Go and deduct the contribution or the consideration, sorry. Yes, deduct the consideration or the contribution from the investment in the balance sheet. Okay, having been able to determine this, here our consideration is just one item, which is cash. So point two will not be really relevant. Point two will not be relevant. If not, you just write consideration 84,000 and then you go to the point three. But if you have more than one consideration, that is when it really becomes relevant for you to compute that item. Okay. So I am cleaning the first part of the question where we determine the group structure. If you have a problem with the determining of the group structure, please say it because sometimes it can beat you like that. Here, at least, we were told that it was per share is this price, so you can easily determine the percentage. In some questions, they don't tell you at all. They don't tell you the price of the shares. So what they do is that they put the share price in brackets. They put the price of the share in brackets here. So they'll just put like this and write 0.5 per share, or they write 0.5 series. It means that to determine the number of shares in the company, you need to divide the value by the amount per share. You need to divide the value per the amount per share. Okay, so look at this. Equity share of 1 CD each. It means that to find the number of shares is for you to divide the value. This is the amount, the value by the number of shares. That will tell you that by the amount per share, that will tell you the number of shares the company had. It's quite 1 CD, so it will be direct. Sometimes you have 50 pesos. That is why I'm stressing on it and emphasizing on that. Okay. Having determined that part of the question, which is one of the question, let us look at any other items we can make here. Now, yesterday I tried showing you that the split account would consider some items for your net assets at acquisition and net assets at end. Now, the net asset at acquisition, I said that it doesn't mean that we should go and bring the assets, but then we use that of the equity So the items under the equity plus any adjustment in a question, that would help us constitute what we call the split account. So first and foremost, I said stated capital will be brought when we are using that of the subsidiary. So it is the same amount for the at acquisition and at year end, which means that your post acquisition will be what? Zero. Which means that your post acquisition will be what? Zero. Okay. So once we are done, it says that when you bought the company had some income surplus of how much? 8,000. It means that 8,000 will be the income surplus at acquisition. Then the income surplus 16,000, but becomes the income surplus at the year end. So the difference between the acquisition and the year end will give you your post acquisition. So always if your um, post acquisition should always be greater than that of it. So it's always the reporting period or the balance sheet period minus the acquisition. That will help you determine the post. I am saying this because some of us will do it and they will ask me, why do you have negative? Because this is how it's going to work. Reporting, the figure you see under reporting minus the acquisition. So if it is a negative answer you get on your calculator, you put the whole negative there under the post-acquisition profit. So this one has income surplus and it has capital surplus. So capital surplus at the beginning or at the acquisition is 13. Then at the year end is also 13. So under capital surplus, we have what? 0. We have 0. Then we come down again and look at any other item. So we are done with footnote number 1. We've established that this was supposed to help us find group accounts. This is our consideration and our cost of investment that must be deducted from the investment too as well, and our consideration for the computation of goodwill. Then the remaining is also supposed to help us to find what we call the split account or your net asset of the subsidiary. Having done that, what is in point 2? Point 2 says that on the date of acquisition, one item of plant of Akachi with a book value of 4,000. So when we were buying Akachi, they are telling us that the plant is worth 4,000. So we have charged depreciation on the what? On the 4,000. But had a fair value of 6,000. What can you say about this question? When we went to market, they are telling us the price is no more 4,000. The price of the item is supposed to be 6,000. Now, when it happens like that, it will affect your net assets both at acquisition and at the end. So you only find the fair value adjustment. Mind you, the item was 4,000 and the fair value is 6,000. And so the difference would give you the fair value adjustment. Some questions will tell you the book value was 4,000 but was adjusted by 2,000. So they have already given you the adjustment. Questions will give you the two, will give you the current value, which is the book value, and the fair value to find the fair value adjustment. Other questions will give you the current value and intentionally give you the adjustment to see if students would apply, to see if students would really apply. So it's there. It's there. I think you'd see some in some questions. Let's focus on this one. So here we have been told the book value. This is what we recorded, but we were supposed to have recorded 6,000. Since we have already recorded 4,000, we don't need to go and record the whole 6,000, but we need to record the adjustment. Now that adjustment, like I said, would affect the split account at both acquisition and at year end. At both acquisition and at year end. Okay. Now, having said that, I stated that if there is a fair value adjustment, there will be depreciation. Now that the fair value is high, it means that we undercharged depreciation. It means that depreciation that was recorded was just on the 4,000. It should have been on the 6,000, which means that we have undercharged depreciation. So we need to charge depreciation rightly. And then they've given us the useful life of the asset. So it becomes the fair value adjustment, which is the 2,000 divided by 4 years to find depreciation for 1 year. So depreciation for 1 year will be what? 2,000 divided by 4,000 will give us what? 2,000 divided by 4,000. Divided by 4, sorry.
500.
500.
Yes.
Okay. So 500 is for 1 year. But then that is when we bought the company. How many years has the company been with us? When we check the period was how many years?
3 years.
3 years.
So the depreciation for the entire period would be the 500 cedis times the 3 years. 500 cedis times the 3 years. Which is going to give us 1,500.
500.
Thank you. So what did I say about if depreciation is undercharged? I stated clearly that you go and less it in the split account. I stated that you go and less it in the split account. I'll not be surprised some of you are seeing stars already, but don't worry, you'll be fine. Now, this is what I'm referring to. This is what we call the split account. So here, you see we have stated capital. When you check the question, why don't I even open this to screen? A minute. Sorry. Okay. A minute, please. Let me open a split screen so that you'll be fine. All right. So let's go. Let's go with what we're doing. Okay. So basically, we said the split account or the net asset at acquisition, the net assets of the subsidiary must start with acquisition, uh, reporting and post-acquisition. And I told you the reporting is also called balance sheet figures. Then the post-acquisition profits. Usually, some put it at the far end. Your lecturer put it in the middle. That is why when I was solving this question, I put it in the middle. So that when you see it in the middle, you don't get confused. Now, but I said it is always going to be the reporting or the balance sheet one minus the acquisition. So we started with a split account from the stated capital. I told you 60,000 for both at acquisition and at reporting. The difference will give you 0. Then we come to pick the income surplus. This one is at the reporting. That is the 16. Then at the beginning was 8,000. That was mentioned in the footnote, 8,000. So the difference will give you a positive 8,000. The capital surplus in our question was 1313, which gives us 0. Then the fair value adjustment, that is the revaluation, the value of the asset. It was supposed to be 6,000, but we recorded 4,000, meaning that there's an increase in it. So that becomes positive for both the pre-acquisition and the balance sheet. The difference gives you 0. There's no post-acquisition on that fair value adjustment. But the consent is that we have what we call depreciation of the asset. And that is what I have worked out for you. The depreciation is that the fair value adjustment figure that you have. Ask yourself, what happened to depreciation? Was it undercharged or was it overcharged? And I said that because the current value is lesser than the fair value, it means that depreciation was undercharged. Every year, I write this for students, and then they go back and come and ask me a lot of questions. Then, if your current value is greater than your fair value, your current value is the same as the book value, you have overcharged depreciation. Now, if you undercharge depreciation, I said go and less it for your split account. So that is the undercharge to depreciation. We less it not from the acquisition, but then it happens to just the balance sheet and it is less. So if I have negative 1,500 minus 0, what would be the answer? Reasons why this is a negative figure. Can you tell? All right. You have a question? Is someone asking a question? Okay. Then
Depreciation
let's
is
go
an,
to, you said?
depreciation is an expense. That's why it's a negative figure.
If you think about it like that, what if the book value was 6,000 and the fair value was 4,000? What would you do? Would you say depreciation is an expense? That is why it's a negative figure. It will be the vice versa. That is why I have specifically written undercharged and overcharged for you. Because there will be a situation whereby they will tell you your book value was 6,000. What you recorded in your book was 6,000. But when they went to the market, the item is actually 4,000. With that, it means that your fair value adjustment will be a negative figure, and then your depreciation will rather be a positive figure. With that, your fair value will be a negative figure, and then your depreciation will be a positive figure. We'll solve a question like that, don't worry. That is when you realize that, hey, so it is not as we are saying depreciation is an expense. No, here in this course, we do what we call application and understanding of concept. If you miss one concept, you miss everything out. Are we together? So,
Yes,
senior,
sir.
who said it was an expense? Please, it is an expense because you undercharged it. That is how come it become an expense. But if you've overcharged someone, you've overcharged an expense, do you think it will become still an expense? You just need to rule it out from the expenses account. It was not supposed to be 40. You have charged 40. It was supposed to be 25. What do? You credit it to reduce the figure. So when you are crediting it, you come and add it here. But since you undercharge it and then you are going to add up to it, which is a debit figure, you will come and bring it here as a negative. Okay. So you can also understand it from that concept anyways. That's fine. Now let's go to the next item, which is point 3. So we are done with point 2. We are done with point 2. Anyone asking a question? I heard someone's mic on trying to ask a question. Okay, so we are done with point 2. Let's go to point 3. It says that during the year, Akachi sold goods to Adidome Limited. Who is Akachi? Akachi is the
Subsidiary.
subsidiary and then has sold goods to Adidome. As at the end of the year, the inventories of Adidome Limited included goods of 4,000. From Akachi. This is the question that I want you to address because Akachi is a subsidiary and we are preparing the net assets book of the subsidiary. If Akachi rather had bought goods from Adidome, that is when we will not bring it. So here, the part that Akachi has left in stock is what we are going to look out for as the unrealized profits. Now, what is the unrealized profits? Someone will say 25% of 4,000. That should give you the unrealized profit because markup is computed on what? Markup is computed on what? On cost. Markup is
Cost.
on cost. And margin is on what?
Selling price.
Selling price. It's on selling price. Very well. Now, if I sold goods to him and then he also bought the goods, is he not supposed to buy the goods on a margin? He's supposed to buy the goods at a margin, but he bought the goods on a markup. So once you see sold, selling price must go with margin. Selling price, sold goods must go with margin. But cost must go with markup. So here, we are going to convert from markup to margin. We are going to convert from markup to what? Margin. Because selling the goods to him should have been on a margin. It is the margin plus the selling price that will give you the margin plus, that is the margin will give you profit, plus the cost that will give you the selling price of the goods. But here it says markup. And we know from margin to markup, except I've not taught you before in class, but I know I did at a point in time in class. From margin to markup is denominator over A. I'm turning the thing upside down. Always the top is a numerator. It's always the numerator over the denominator minus the numerator. So from bigger to smaller, am I doing the right thing? Yes, so from bigger to smaller, you less the numerator from it. But from markup to margin, markup is like a small brother of margin. But from markup to margin, it is the opposite. You add. You add. So that one will be numerator over denominator plus numerator. Now, what do I mean by this numerator denominator? You said markup of 25%, but it is on sold goods. So we need to convert the markup to a margin. So what is 25 over 100 plus the 25? The 25% means 25 over 100. So it is going to be 25 over 100. 25 over 100 plus 25. Which is going to give you 25 out of 125
20%.
times 100, which is what? 20%. So converting 25% markup to margin is a 20%. So we are not supposed to use the 25 on the goods remaining to determine the profit because the goods was sold to us on a selling price and we don't know the profit component and the cost component. Therefore, the goods that are left is 4,000. We want to know the profit aspect of the goods that are left. That is what we call the unrealized profit. You have some 4,000 goods in stock. We want to know the profit part in the goods that is left. But how do we know the profit in the goods that is left? The goods were on selling price. So whatever amount you have there is a selling price amount. And we want to know the profit aspect of it. To know the profit aspect of it, we are saying that markup mentioned in the question means that if you do markup on cost, you get a profit. If you do margin on selling price, you get the profit. But we can't do markup on selling price figure to get the profit component. So we have to then change the markup to margin because of the sold here to be able to know that, okay, we can now apply a margin on the margins figure. And then someone said it is 20% when we did the conversion. So 20% of the 4,000 cedis would tell you the profit aspect of the item, 800. Now, it means that the price of the goods is actually 3,200 and not 4,000, which means that the goods were supposed to be have purchased on 3,200, but then they have given you the profit plus the selling price all together, and meaning that you need to consume it. Now, that part of the profits that you did not realize, we say come and deduct it from your working. So it is called unrealized profit because the goods are still in inventory. Because the goods are still in inventory, it says, as at the year end, the inventories of Adidome included 4,000 of the goods from Akachi, meaning that you've not sold all the goods. The goods are still with you. That is how come we call it unrealized profit, because that profit, you've not actually realized it. You only realize it when you sell it. But since you have them in inventory and then you've not realized the profit, we say that come and less that profit from your determination of your post-acquisition profit. So that is the 800 you see here for unrealized profits. So the footnote number 3 has what we call unrealized profit in it. That's all. Okay, then let's go to footnote number 5. This is cash in transit, and that would also factor in the cancellation of intragroup transaction. This is an intragroup transaction. Now, we are not supposed to have even sold the goods, so we are trying to cancel it. Now that we are trying to cancel this one, the 500 has been paid from your cash. What happens? If you pay something out of your cash, what do you do to reverse it? Yes, anyone? If you pay, it means that you are crediting it. To reverse it means you have to do what?
Debit.
All right. So we'll be doing some debit credit here. In the first place, you shouldn't have sold the goods to Akachi. So in the books of Adidome, where he says he owes Akachi, so here we'll be doing debit credit in here, and we'll be doing another debit again. Why am I saying debit? Already in the books of Akachi, he has recorded Adidome, which is a debtor. So if we credit the debtor of the entire amount they owe, 3,200, and we debit the creditor to cancel the transaction of 2,700. Where is that 500 difference? The 500 difference was paid out of cash. So cash or bank has left them. So we now come and debit cash and bank of the 500 to ensure that our debit side is corresponding with our credit side. That is why I am asking you, if I have parted away with money, it means that I have what from my bank? It means that I have credit my account. How do I reverse the inventory, the entry? I need to debit it. That is how come you see debit cash or bank with 500. Then you come and also correct this transaction. So in your new statement, when you open current account and write Adidome 3,200, you must also less 3,200 from it. Then in your bank, you come and add with a bank, when you open 10,000 plus 5,500, you come and add the 500 again. Because if I debit my asset, it means that I am adding to the asset. If I debit my creditor, which is the 2,700, it means that I am closing that account. If I credit my data of 3,200, which is this Adidome, it means that I am closing on the Adidome account. Is that fine? Is that fine?
Maybe you should try applying it.
I should try applying it for you.
Yeah.
I should try applying it for you. Okay. So, intra-group transaction. This is it. Credit Adidome's account with the 3,200 to cancel the 3,200 in the debtor's account. You debit Akachi's account with the 2,700 and the extra 500, which is goods in transit. We also say current assets. Current assets. Debit bank or cash. Debit cash or bank, 500.
One.
When it happens that like that, you have closed on this account. The investment in a subsidiary, which is the 8,400 we saw at the initial, this one, comes to cancel that investment in the account. Okay, so we apply it, but we are doing the workings. When we are done and we are preparing the final account, we apply it, okay. We apply it so that you see what I'm talking about. Now, still on the footnote number. So this 500 was just to mean that there is no intragroup transaction that must take place. So parting away with money to go and pay for a debt you owe, reverse the entry. That's all. You are not supposed to have paid for it, and then you are paying for it. The policy says that any intragroup transaction, cancel it. So why would I pay for goods that I bought from my subsidiary? They said cancel it. So we need to what? Cancel it out. And then if I part away with money to pay them, canceling it out is the reverse entry. Okay, that's fine. Footnote number 5, which speaks about impairment. Impairment happens to an intangible item, but then some of the intangible items amortizes. So rather than to say depreciation, impairment is like a bad debt on the account. So they did an impairment review and then they realized that your goodwill in Akachi had fallen by 500. And then in January 2, it has suffered an impairment of 1,700. So total impairment suffered is what? 1,500 plus 1,700, which is the 2,200. Now, impairment also affects your balance sheet and affects what we call your post-acquisition profit. So if you look at this too, we've canceled it out. So these are the items that come in. So you realize that the dipping ones, where I have dipped, means that they were not in the equity. They came as a result of reading the question. Now, the next item, the next two items, they are not really much of a problem because it is just telling you the number of shares, and here it is telling you that the non-controlling interest aspect of the company has a market price. It has a market price, which would help us in the computation of NCI and then also help us in the computation of our goodwill. Help us in the computation of our goodwill. Okay. So when we have done discussing this point 6 and point 7, the rest is for us to go ahead and do all the workings that are left in the question. Now, the first one is to consider goodwill. Goodwill must start with a consideration. So when you add all your pre-acquisition, all the reporting period, we have 86508300. Now, this one is very important to us. This one, the pre-acquisition, the at acquisition, it is very important because we need it for the goodwill. And that is what you see normally here in the goodwill computation. I used to teach full approach and partial approach, but with recent times, what IC is doing or what the standard is going, we don't see the partial approach again. All we see is the full approach. And that is what we have done here. The consideration you have received, and then the fair value of the assets. Now, someone will ask, so why are you multiplying it by 1,200? Someone has bought 48,000 shares of 60,000 shares. How many shares is for the non-controlling interest? How many shares are for the non-controlling?
1,200.
Are you sure you understand it?
Yeah.
Yes.
You less the 48,000 from the 60,000.
That'll be the
The
difference.
That's
difference
the
of it,
difference. That is 12,000.
12,000. Yes.
So 12,000, and then they are telling you that their shares, one is being sold for 1 cedi 40 pesos. So the fair value of the non-controlling interest is the amount they are selling their shares times the number of shares they have in the company. So that will give you a total consideration. So you add theirs, the NCI's own, to that of how much the parent has paid for the company. This course is very interesting. You do the mother of this course in block second semester. So if you really understand this one, doing the mother of it makes it very easier. That place, when you are doing consideration, you open your mouth wider and then ask yourself, what are we doing? When we are determining goodwill, it's very beautiful. Very, very beautiful. Okay. So this is just a total figure. And we said that total consideration, which is the consideration from the parent and the fair value of the NCI, minus the net asset at acquisition, should give you a goodwill. So basically, this should have been our goodwill, 17,800. But the goodwill has suffered like a loss. An impairment is like a loss. So the goodwill has suffered an impairment, which is 2,200. Once you less the 2,200 from it, this becomes our goodwill. So this goodwill must be sent to the statement of financial position as a non-current asset. That is why you left a space there. So once you determine goodwill and it is positive, straight you send it to the net asset at the current non-current asset part of the question. So you realize that when I was telling you, I told you when you write, you leave some space. So leaving that space means that we are going to fill in that space with what we call the goodwill. The goodwill. So that would explain. We've done point 1, point 2. You've closed on the split account. Now the post-acquisition profit, we will need it when we are doing NCI. Okay, and we'll need it when you are doing consolidated retained earnings. That is why we did the split. So in the split account or the net asset of the subsidiary account, we need just this one for goodwill computation, and we need this one for both NCI computation and retained earnings computation. I would close in on the NCI, and when we meet the next time, we'll do the retained earnings and prepare the financial statement so that you know how the financial statement would go about. Okay, now what is NCI? I just told you that one, we pick their fair value and then we add the percentage of the NCI on the post-acquisition profit. That will just give us the NCI. So you see, their fair value amount is 1680. That is the number of shares times their market value. The number of shares they had times their market value. That gives us this figure. Then we find the profit, the percentage of the NCI. If the parent had 80% control, then it means that the NCI had 20% control. So anything that they made as profit must be split and shared between the 20% of 3,500 gives us 700. Then we add them on. We add them on to get what we call the total NCI. The total NCI. We have closed in on almost everything. This question has the simple footnote information. It has the simple footnote information. So you need to pay attention to it closely and then revise and revise. Now, so we are not done. We are not done. We've only discussed the items in it. And we've discussed what we call the workings. We are supposed to now prepare the statement of financial position. So you see what the workings can do to you. So if you've already written down the format and then you are wasting so much time on them, if you don't understand any footnote item, skip it. You might understand the second footnote item. It is not a must for you to understand all the footnote items. You might understand some footnote items that will award you some marks. The footnote number 2 is easy to understand. Footnote number 1 is easy to understand. Where the problem normally comes is footnote number 3. How to know whether you are going to convert to markup to margin. That is when the confusion will come in. But if you are too familiar with and we solve more questions, you realize that, oh, this thing, it is no problem because they sold the goods out and it was on markup. Sales is not on markup. Then you now quickly look at it from converting it to do what you have to do. But if you are said, Adidome, acquired goods on cost from this, then it means that, okay, cost and markup, they relate to each other. Now, that is understanding the perspective of markup and to determine the unrealized profits. To determine the unrealized profit part of it. Then the next one is that this one is simple. Goods in transit. I can just easily analyze it and go my way. Okay. Now, this question happened to be the very question the lecturer solved last year with your colleagues. So I've decided to take the lead and then explain. Just go over it again, and then maybe you appreciate it. So we'll prepare the statement of financial position in class. Time is fast spent. This had been what over the years they have been experiencing. This question. It is called tangent and latrine. Tangent and latrine. Now, this question is a bit. That is why I started with the ha 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 ha. So when we are doing the you see the footnotes items. It is power packed. It is really power packed. And so if you are doing it, you need to sit down and understand the concept before we start it. You see the footnote here, you see goods in transit, you see cash in transit, you see dividend paid here, you see the net asset at acquisition, all of them, they are all in this question. So this question is really packed. But then over the years too, if you check the past question, the first past question, 2021, the same question dropped, nothing changed. And the first question they asked them was that determine property, plant, and equipment. Determine goodwill. Let us know the investment in associates. So this question had an associate. It had an associate. So we don't want to skip the gun and go to an associate. That is why I taught Adidome and Akachi, which just has a parent and a subsidiary. When we pick that and then we are discussing it, you realize that, oh, there is something called an associate, and this is how we treat an associate. We have, you see, so it follows in a chronological way. If you don't get them correct, everything turns out to be wrong. And it's about 20 questions. That is why normally I don't pray you get an objective, because if you mix it out, you mess the whole thing up. All right. This type of consideration here in the consideration determination, it had all the consideration that I needed. Here, you are not determining group structure. They've already given you the group structure determination. Now look at it. It says loan. So your consideration had loan here. Your consideration had a share exchange here. It had a share exchange. Yes, it says by means of share exchange of 2 shares in Tangent Co for every 3 shares in Latrine Co. So it has share exchange. It had loan. I think it even had cash exchange to cash in there. So here the consideration became more than 1 and was about 2 to 3. So let's go up back and revise on whatever we have picked from here. We'll continue with the consolidated retained earnings. Though it's not much, I need to give you the entire format on consolidated retained earnings. If I tell you what it is like from here, you look confused. So let's go back, come back again, and I'll give you the breakdown of consolidated retained earnings, and I will do it. It's simple, but just that I didn't want to touch it now, because next time when I'm doing consolidated retained earnings, you come and ask me, say, how did you or where did you pick this figure from? So, any question before we close? Any question?